Joining us now is George Tsilis, senior markets correspondent, to give us some more clarity here. So, George, I mean, there's a lot to like within this report, especially annual recurring revenue. I saw of note by several of the analysts covering this name.
Yeah, this is an improving business. I mean, we talked about SentinelOne. It was probably back when CrowdStrike had their outage, which was a while ago, and CrowdStrike certainly has recovered since then. But SentinelOne has actually been underperforming as a cybersecurity stock. In the last year, it's down about 23% year to date. It's down around 11 or 12% even after today's move. But nonetheless, it is a play in the smaller space for cybersecurity, particularly when it comes down to autonomous endpoint security solutions. And endpoint security really focuses on what it means, what it sounds like, which is the endpoint, like computers, phones, and so forth. But they did denote some pretty good numbers, and they're getting closer towards consistent adjusted profitability. And I'll talk about their net income problem that they have, which is, again, improving. But if you look at the EPS numbers, they actually printed around 4 cents a share. Estimates were 3 cents, so they did beat it by a penny. And last year, they earned about a penny per share. So this was a market improvement from last year, and sales basically came in line, slightly higher, but didn't in line with 22% increase. Now, they did denote also that average recurring revenue increased by 24%, which was slightly higher than top line total sales, which gives you a little bit more visibility on the forward revenue guidance that the company's providing. And they did also increase their fiscal year guidance for top line sales. And I think this is also, again, when you start to see companies like this, which are getting closer towards GAAP profitability, which they're kind of way off still in that regard, some of the analysts find that very bullish. And so if you look across the board, analyst firms like Cantor, Fitzgerald, JMP, Guggenheim, all together upgraded the stock to a buyer outperform ready with a $24 to about $29 price target.
George, we've seen industry consolidation. Seems like this company's about to turn the corner. Not a huge price tag, especially given the depreciation over the last several years. Is this one that you could see one of the bigger names gobbling up maybe in the future?
Well, it's quite possible. I think that, first the company has to get closer towards some GAAP profitability. So if you look at the adjusted numbers, they were profitable, but I did notice in the last 4 quarters, which I think corresponds to some of the price action weakness we've seen, they've got a negative net income margin of around 40%. So, maybe they're way off in terms of, being an acquisition target. Not necessarily because of the technology. I think it comes down to the financials. Now, typically speaking, when companies either get closer to profitability or are profitable, they become a little bit more of an attractive target. So even though the technology is there, they don't necessarily have the scalability profile that a company like CrowdStrike has, which altogether did suffer that outage, which created an opportunity for SentinelOne. They did capitalize on it, but it didn't look like it was a long-standing capitalization or opportunity that they took advantage of. But nonetheless, the company is growing. And again, as they get closer towards, net income profitability, that's typically where you see these big moves. So, today's report or yesterday's report is a good starting point for a potential major trend reversal, but nonetheless, they still have some improving to do.
Yeah, that is very true. And also, this has been a very, I'd say, lucrative space for a lot of these earnings periods. But I mean, again, they have to continue to grow and, continue to own some of that market shares. This is going to be, I think, a fairly competitive space to watch going forward. But appreciate that, George.